The passing of the Genius Act marks a significant milestone for XRP and its ecosystem. This video will explore why this legislation, although focused primarily on stablecoins, holds particular importance for the XRP ledger. The stablecoin narrative has, to some extent, overshadowed the critical role they play in ensuring XRP's long-term success. Additionally, I will discuss why XRP stands to benefit the most from this development and provide an update on the timeline for XRP ETFs. Stay tuned, as this is essential information you won't want to miss. Let's begin by discussing some of the key highlights from the XRP Genius Act. One particularly noteworthy aspect is the provision stating that the Treasury may block non-compliant foreign stablecoins. In my view, this appears to be a direct reference to Tether, suggesting that it is being identified as a non-compliant stablecoin. The Act specifically addresses foreign stablecoins, such as Tether, and grants the Treasury the authority to restrict these issuers from operating within the United States market. In my view, this development is one of the most surprising aspects we've seen so far. Some may argue that it isn't surprising, as there has long been speculation about Tether being excluded from the market. For a time, it did appear that Tether would face significant challenges. However, there were notable connections between individuals close to Tether and the Trump administration, which raised the possibility that efforts might be made to protect Tether's position. It now seems there is a renewed push to ensure Tether remains excluded from the market. This shift creates a significant opportunity for RLUSD, with USDC now issued on the XRP ledger and RLUSD emerging as Ripple's stable. The two most compliant stablecoins currently available are those that financial institutions are beginning to adopt for use on the XRP ledger. If we examine the current trajectory of stablecoin growth, it is clear that the sector is experiencing exponential expansion. As previously discussed, this marks the beginning of a transformative era in the evolution of money. We are witnessing the early stages of fiat currency tokenization, which is only the starting point. This trend will extend to bonds, derivatives, and various other forms of value, all issued natively on-chain. The tokenization of assets such as currency, bonds, and debt significantly enhances their utility and efficiency, underscoring the economic benefits of this innovative approach. Stablecoins have already surpassed the transaction volumes processed by major legacy companies such as Visa and PayPal. The fact that stablecoins developed in an unregulated market are achieving volumes comparable to these established corporations, each with over 25 years of history, is nothing short of revolutionary. This remarkable growth is a testament to their potential, and it is expected to accelerate further. Currently, we are witnessing significant transaction volumes and supply within the stablecoin market, despite the absence of proper regulatory frameworks that would enable widespread adoption by established businesses. The potential for exponential growth is immense once regulations are in place to provide clarity and encourage broader participation. This moment can be likened to the pre-regulation era of the internet, akin to the late 1990s and early 2000s. We recently witnessed a historic moment with the introduction of legislation that paves the way for a transformative use case of cryptocurrency, the tokenization of currency. While some may question how this development benefits XRP, given its apparent focus on stablecoins, it's important to examine how the XRP ledger is uniquely positioned to thrive in this evolving landscape. The XRP ledger was purposefully designed as a decentralized clearinghouse, with XRP serving as the liquidity mechanism for this system. Notably, it was the first blockchain to support tokenization, anticipating the emergence of various forms of digital value. Its creators understood that not all assets in the digital economy would be denominated in XRP or Bitcoin. This vision was not about dismantling traditional financial institutions, eliminating governments, or ending debt, bonds, or equities. Instead, it was about creating a system capable of complementing and working alongside existing frameworks in a digital tokenized economy. Bitcoin enthusiasts believed that Bitcoin would not derive significant benefits from stablecoins, as its design and purpose did not align with leveraging such assets. In contrast, the XRP ledger adopted a fundamentally different approach. It recognized that various forms of value and assets would continue to exist and focused on creating more efficient infrastructure and tools to facilitate their movement, conversion, and settlement. The XRP ledger was specifically designed with tokenization in mind, enabling the representation of diverse forms of value. However, a key challenge remains. Even in a tokenized system, the lack of trust between parties and the absence of liquidity between different assets create hurdles. Without sufficient liquidity, individual liquidity pairs must be established for every asset, complicating seamless value exchange. Imagine a central source of liquidity, a single, neutral, and decentralized asset to which everything is liquid. This is where XRP comes into play. XRP not only enables the efficient tokenization of various assets, providing them with multiple avenues for utility beyond their primary use cases, but also facilitates instant decentralized liquidity. This allows for seamless auto bridging between assets, creating a unified and streamlined financial experience. The XRP ledger serves as a decentralized financial clearinghouse, seamlessly integrated into the framework of the internet. It was designed with the foresight that the future of finance will not be limited to a Bitcoin-only ecosystem. Currencies are increasingly becoming tokenized, which aligns perfectly with the purpose for which the XRP ledger was originally designed. The developments we are witnessing today further validate Ripple's vision from the beginning. Stable coins will inevitably play a significant role in the financial system, and while governments will regulate these innovations, they are not going away. Ripple anticipated this future, and the XRP ledger was specifically designed to accommodate these regulatory frameworks while enabling stablecoins and issued assets to thrive. As mentioned earlier, the XRP ledger was built with issued assets in mind. However, given the competitive landscape, it's worth noting that other blockchains such as Bitcoin and Ethereum currently lead in terms of market capitalization. Earlier today, one of the creators of Solana shared a thought-provoking perspective regarding the future of blockchain technology. They highlighted that it is unlikely we will require multiple chains to support infinite smart contracts. Both Solana and Ethereum already possess the capability to handle infinite smart contracts. To elaborate, they argue that the concept of having multiple layer 2 solutions may not be necessary. If a single layer 2 can manage parallel execution effectively, it could utilize all available blob space and accommodate every potential use case. Furthermore, they pointed out that the number of truly useful smart contracts, as well as execution environments, is not infinite. While this reasoning appears logical, they suggest there may be flaws in the assumption. There are only a limited number of smart contracts that hold significant importance, as the demand for developer opportunities is not infinite. In fact, introducing excessive developer optionality that increases business risk can be detrimental, much like the ERC20 interface. This aligns with a long-standing perspective shared by Ripple and the XRP ledger. Full smart contract functionality on-chain is not always necessary. The primary purpose of such functionality is often to experiment and identify which contracts prove successful rather than providing immediate and essential utility. While it is valuable to have the ability to implement smart contracts, this should ideally be done in a controlled test environment rather than on the main blockchain. The XRP ledger is one of the few blockchains that has taken a deliberate approach, choosing not to overload the system with an extensive number of smart contracts from the outset. Instead, the focus has been on identifying which smart contracts are essential, such as those for decentralized exchanges, DEX, and determining which ones may not be necessary. This careful evaluation prevents the network from being burdened by an unlimited number of smart contracts, which could compromise its utility and overall efficiency. In contrast, blockchains like Ethereum and Solana have opted to allow the deployment of an unrestricted number of smart contracts on their main chains. This approach has led to network congestion and diminished scalability, making these blockchains less suitable for production-level environments. The thoughtful strategy of the XRP ledger aims to preserve functionality and ensure readiness for real-world applications. Large financial institutions are understandably cautious about the risks associated with interacting with potentially malicious smart contracts. It is not a risk they are willing to take. This highlights one of the key strengths of the XRP ledger, which was designed from the outset with such concerns in mind. This foresight positions the XRP ledger as a preferred platform for financial institutions to engage with assets like stablecoins. In contrast, Bitcoin, while a leading cryptocurrency, does not have a direct connection to stablecoins. Ethereum, though widely used, struggles with scalability issues, resulting in high costs and slow transaction speeds due to its focus on complex smart contracts, which has rendered the network less efficient. Similarly, Solana has faced challenges by following a comparable path. Solana has similarly implemented infinite smart contracts. Meanwhile, the XRP ledger stands out with minimal competition, positioning itself to lead and dominate this new era of on-chain issued currency. The XRP ledger is uniquely positioned to capture the majority of this volume, particularly when considering Ripple's established relationships with major banking institutions, which are expected to issue a significant portion of the value transitioning on-chain. On a related note, regarding the XRP ETF situation following several delays, the SEC's final deadlines for these ETFs are anticipated to be announced in October. I have consistently noted that expectations for significant developments occurring in early summer were overly optimistic. Instead, late summer to early fall was always a more realistic timeline, and current events appear to support this perspective. The introduction of XRP ETFs is on the horizon, but the possibility of them being implemented earlier in the summer was unlikely from the start. The process requires time to ensure everything is properly aligned. Recently, pricing data was finalized. The CME listed XRP futures to validate this data, and it was subsequently submitted to the SEC to establish pricing information on equity exchanges. With these prerequisites now in place, the necessary groundwork has been laid. The final timeline still points to late summer or early fall, and there have been no indications of any significant changes to this schedule. XRP ETFs are well positioned to cross the finish line in this time frame. It is important to acknowledge that traditional brokerages and regulators face significant infrastructure challenges that will take time to address. These changes are not expected to happen instantaneously. Based on the current outlook, we remain on track for these developments to occur in late summer or early fall, a timeline I have consistently adhered to. While progress is unlikely to accelerate beyond this, I wanted to provide this update for your awareness. These advancements will serve as a significant catalyst once implemented, so I encourage patience as we approach these milestones. The next major development to watch for is Judge Torres' forthcoming ruling, which may involve lifting the injunction, reducing Ripple's fine, and subsequently allowing us to shift focus to ETFs. Thank you for taking the time to review this update. I hope you find it valuable.